Hi, everyone. My name is Jed Barker with Best Life Mortgage. I help homeowners across South Carolina understand their options when it comes to home financing, especially ways to make the most of the home you've worked so hard to build equity in. Today, I want to share with you simple and powerful ways you can access that equity safely if you ever need it, either through a home equity line of credit, HELOC, or for some homeowners, a reverse mortgage. This isn't about selling anything. It's about giving you clarity and confidence in the options you already have. Over the years, your home probably became one of the biggest investments. Home equity is simply the value of your home minus what you owe. For example, if your home is worth $400,000 and your mortgage is paid down to $100,000, you've got $300,000 in home equity. That equity is like a financial safety net, and today there are smart ways to use it when you need access to funds. A HELOC or home equity line of credit is kind of like a credit card, backed by your home equity. You can borrow what you need, pay it down, and borrow again as needed within set limits. Here's how it works. You're approved for a maximum limit of, let's say, $100,000. You can use it when you need it, maybe for home repairs or medical costs or helping family members. Only pay interest on what you actually use. Some advantages are lower interest rates than credit cards or personal loans, flexibility, borrow when you need it, pay it back when you can. Often interest may be tax deductible if used for home improvements, but check with your tax advisor on this one. This is best for people who need or want short-term access to funds without permanently increasing their monthly bills. For example, let's say your roof needs replacing, or you'd rather not drain your savings. A HELOC can cover that cost, and you can back it up, pay it back over time instead of all at once. It's flexible, affordable, and smart. Next, let's talk a little bit about reverse mortgages. These are for people or homeowners who are 62 years or older. A reverse mortgage, also called a home equity conversion or a HECM, this program allows you to turn a portion of your home equity into cash, either as monthly income, a line of credit, or a lump sum, without having to make monthly mortgage payments. You keep homeownership in your home, and you're still responsible for property taxes, insurance, and maintenance. The balance is repaid when you sell the home, move out permanently, or pass away, typically from the sale of the home. Now, who does a reverse mortgage help, or who benefits from a reverse mortgage? Here's a few examples. Retirees who are house rich and cash poor, those who want to stay in their home and supplement their retirement income, or people who want to pay off an existing mortgage to eliminate monthly payments. Example, if you own your home free and clear, a reverse mortgage can give you access to a portion of that equity. Let's say $200,000, which you can use to improve your home, cover healthcare expenses, or simply enjoy your retirement more comfortably. Is it safeguarded? Yes. The home equity or the HECM is federally insured through the FHA. You can never owe more than the home's value when it's sold. Let me just say that one again. You can never owe more than the home's value when it's sold. Heirs can choose to keep the home or sell it. They're not personally liable for the debt. I'll repeat that one again too, because that one comes up quite a bit. Heirs are not personally responsible for the debt. Now, how do you choose the right tool? Which one is best for you? Because both tools can be excellent, and it depends on your goals. If you want flexible access to funds you plan to repay, a HELOC is great. If you want to stay in your home and have no payments, a reverse mortgage might make more sense. Now, there are some common misconceptions when it comes to these loan types. I'm going to go over just a few for you. I'll lose my home with a reverse mortgage. Not true. You stay on title and remain the homeowner. The bank owns my home. Not true. You always own the home as long as you meet the basic obligations. My kids are going to get stuck with my debt. Not true. The home pays the loan back. Your heirs aren't personally responsible. HELOCs are risky. When used wisely, they're actually one of the most unrisky or most cost-effective tools for short-term borrowing. Some smart ways to use the home equity, as I mentioned in just a moment ago, again, would be medical expenses, home upgrades, helping family members, or supplementing your income. You might consider some of these options if you're living on a fixed income but need access to funds for home repairs or medical costs. You want to help your kids or grandkids financially without selling your home. You want to eliminate your existing mortgage payment to free up cash each month, or you're planning to stay in your home long-term and want to make it more retirement friendly. The biggest takeaway I'd like to leave with you today is your home is not just a roof over your head. It's one of the most important and most powerful financial tools you have. Whether through a HELOC or a reverse mortgage, the key is to understand your options before you need them so you can make the best decision for your life and your family. If you'd like to talk about your specific situation, I'd be happy to take a few minutes with you personally. No cost or obligation. I'm just here to help. My name, again, is Jed Barker with Best Life Mortgage. Thanks for your time, and I hope this is helpful and that you feel more confident about using your home equity wisely.